Ever looked at a stock market chart and wondered, what's the story behind those green and red candles? Believe it or not, each candle on the chart is like a tiny diary entry of market activity during a specific time. Understanding these candles is the first step toward mastering stock trading. In this video, I'm going to teach you what OHLC means, how green and red candles are formed, why understanding candles is critical for traders, plus an exercise to identify OHLC on real charts. So, whether you're a beginner or just brushing up on your basics, stick around till the end. It's going to be worth it. Let's start with the basics. OHLC stands for open, high, low, and close. These four data points tell you everything about the market's behavior during a specific time frame. Open price. This is where the price started when the candle began forming. High price. This is the highest point the price reached during that time. Low price. This is the lowest point the price dropped to during that time. Close price. This is where the price ended when the candle was completed. For a green candle, the close price is higher than the open price. This indicates a bullish movement. Buyers were in control and prices went up during this time. For a red candle, the close price is lower than the open price. This indicates a bearish movement. Sellers dominated and prices went down. Now, let's break down how a candle is formed step by step. The open price. This is the first trade that happens when the time period starts. It's marked by the start of the candle body. Price movement. As trading happens, the price moves up and down. The highest price reached during this time forms the high, and the lowest price forms the low. The close price. When the time period ends, the price at that exact moment becomes the close price. If the close is higher than the open, you get a green candle. If the close is lower than the open, you get a red candle. The thin lines above and below the candle are called wicks or shadows. These represent the price extremes during the period. The upper wick shows how high the price went. The lower wick shows how low it dropped. Sometimes you'll see candles with no wicks. This means the price only moved between the open and close with no extremes. Now, why is this important for traders? Candlesticks are not just random shapes. They're the foundation of price action analysis. Identifying trends. A series of green candles indicates a bullish trend. Prices are rising. A series of red candles shows a bearish trend. Prices are falling. Spotting reversals. Long wicks can sometimes signal a reversal is coming. For example, if a green candle has a long upper wick, it means the price tried to go up but faced heavy selling pressure, support, and resistance. Candles help identify key levels where the price tends to stop or reverse. Understanding OHLC and candle behavior gives you a solid base for building strategies and making better trading decisions. Let's put your knowledge to the test. Can you spot the open, high, low, and close on this green candle? Now look at this red candle. Where's the open, high, low, and close? Let me know in the comments how many you got right. And remember, practice is what makes you a pro at reading charts. Before we wrap up, here are some tips to help you master candlestick analysis. Always analyze candles in context. Look at the previous candles to understand the bigger picture. Don't rely on a single candle for decisions. Look for patterns and confirmations. That's it. You've just unlocked the basics of reading candlesticks and understanding OHLC. From identifying trends to spotting reversals, candles are your best friends in the stock market. If you found this video helpful, smash that like button and subscribe to the channel for more simple and effective stock market lessons. Don't forget to share this with a friend who's just starting their trading journey. See you in the next video. And until then, happy trading.